studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
Before we start preparing the T2 return, the first step is understanding the client. In this case study, our client is Barnes Dentistry Professional Corporation, a professional corporation operating a dental practice. As tax preparers, we should never begin by jumping directly into tax forms or schedules. Instead, we start by understanding the business, reviewing its financial information, and identifying the different types of income earned during the year. Looking at the corporation profile, we can see that Barnes Dentistry is a professional corporation operating in the dental industry. Its tax return will be prepared using a T2 corporation income tax return. Now let's examine the income earned during the year. The largest source of income comes from the corporation's dental operations. The practice generated $372,000 of active business income. This represents income earned from providing dental services to patients and operating the day-to-day business. Next, the corporation earned $17,600 of interest income. This income likely came from bank accounts, GIC investments, or other interest-bearing assets held by the corporation. The corporation also earned $5,750 of rental income from investment property. This is considered passive investment income and will be treated differently from active business income for tax purposes. In addition, the corporation received $21,900 of eligible dividends from other Canadian corporations. Dividend income follows its own reporting rules and will require separate tax calculations. Finally, the corporation realized a capital gain of $10,800 from the sale of investments. Capital gains are subject to special tax treatment because only a portion of the gain is taxable. Now step back and look at the overall picture. This corporation is not earning just one type of income. It earns both active business income and several forms of investment income. That distinction is extremely important because different income types flow through different schedules in the T2 return. Some amounts will affect Schedule 7. Others will require Schedule 3 or Schedule 6. And all of the results will eventually flow into the corporation's final tax calculation. This is why the first task of every tax preparer is not entering data. It is understanding the client and understanding the sources of income. Once we know what the corporation earned, we can determine which schedules are required and how the T2 return should be prepared. The key takeaway from this slide is simple. Before preparing any corporate tax return, understand the business, identify every source of income, and build a clear picture of the client. Everything else in the T2 preparation process starts from that foundation. Now that we understand who the client is and what income was earned during the year, the next step is learning how a professional tax preparer approaches the file. One of the biggest mistakes new preparers make is jumping directly into tax software and entering numbers. Experienced tax professionals do the opposite. They analyze the file first and enter data later. Let's walk through the process. The first step is reviewing the financial statements. Every T2 return begins with the corporation's accounting records. The income statement, balance sheet, and supporting notes provide the information needed to understand the corporation's activities during the year. At this stage, the key question is simple: what income was earned? Once the income has been identified, we move to step 2, identifying the income types. Not all income is treated the same way for tax purposes. Some income may be active business income. Some may be passive investment income. Some may be dividends. And some may be capital gains. Before any tax calculations can be performed, each income item must be classified correctly. This classification process is one of the most important skills in corporate tax preparation because every classification decision affects the schedules and tax calculations that follow. Next comes step 3, determining the required schedules. Once we know what types of income exist, we can determine which T2 schedules are needed. Capital gains require Schedule 6. Dividend income requires Schedule 3. Investment income flows through Schedule 7. Other tax calculations may require Schedule 53, Schedule 1, and additional supporting schedules. At this point, we're building the framework of the return before calculating any tax. Step 4 is performing the tax calculations. This is where the technical work begins. We calculate aggregate investment income, or AII. We calculate adjusted aggregate investment income, or AAII. We calculate Part 4 tax on dividends where applicable. We determine taxable capital gains, and we evaluate refundable tax balances and small business deduction implications. Only after all of these calculations have been completed do we move to the final step, preparing the T2 return. The completed schedules flow into the corporate tax return. The tax payable is determined, and the return is reviewed and finalized for filing. Now take a look at the tax preparer mindset panel on the right side of the slide. This is how experienced professionals think throughout the process. They constantly ask questions. Where did the income come from? Which schedule reports it? Does it affect the small business deduction? Does refundable tax apply? Is all the required information complete and accurate? These questions guide the entire preparation process. The most important lesson from this slide appears in the banner at the bottom. Good tax preparation starts with analysis, not data entry. Tax software can perform calculations, but it cannot replace professional judgment. The preparer must first understand the client, understand the income, determine the required schedules, and understand the tax implications. Only then can an accurate and reliable T2 return be prepared. The key takeaway is simple. Successful corporate tax preparation follows a process. Review the financial statements. Identify the income. Assign the correct schedules. Perform the calculations. And then prepare the final return. That structured approach is what separates a professional tax preparer from someone who is simply entering numbers into software. At this stage, we understand the client and we understand the preparation process. Now it's time to build the T2 return. The most important question a tax preparer asks at this point is, where does each income item go? Every income item earned by the corporation must be reported on the correct schedule. If an amount is reported on the wrong schedule, the tax calculation can be completely incorrect. Let's start with the corporation's active business income. Barnes Dentistry earned $372,000 from its dental practice operations. Because this income comes from the active business, it is reported through Schedule 125, which contains the corporation's financial statement information. This is the foundation of the corporate tax return and represents the corporation's primary business activity. Next, let's look at the interest income. The corporation earned $17,600 of interest income from bank accounts, GICs, and other investments. Interest income is considered passive investment income. As a result, it flows directly into Schedule 7, where it becomes part of the aggregate investment income calculations. Now consider the rental income. The corporation earned $5,750 from rental activities. Like interest income, rental income is also passive investment income. It is reported through Schedule 7 and contributes to the corporation's investment income calculations. Next, we move to the eligible dividends. The corporation received $21,900 of dividends from other Canadian corporations. Dividend income follows a unique reporting path. The dividends are first reported in Schedule 3. Schedule 3 performs the dividend-related calculations, including Part 4 tax, where applicable. The relevant information then flows into Schedule 7 and eventually into the overall corporate tax calculation. Now let's look at the capital gain. The corporation realized a capital gain of $10,800 from the sale of investments. Capital gains are reported first in Schedule 6. Schedule 6 determines the taxable portion of the gain. Once that calculation is completed, the taxable capital gain flows into Schedule 7 as part of the corporation's investment income. Notice what happens in the middle of the slide. Schedule 7 acts as the investment income hub. It receives interest income. It receives rental income. It receives taxable capital gains from Schedule 6. And it works alongside information from Schedule 3. Schedule 7 then calculates aggregate investment income, or AAI, and adjusted aggregate investment income, or AAI. These calculations play a major role in determining the corporation's tax position and potential small business deduction implications. After all schedules have completed their calculations, the results flow into Schedule 1. Schedule 1 performs the corporate tax reconciliation and serves as the bridge between accounting income and taxable income. Finally, all of the information flows into the T2 Corporation income tax return. At this point, the return is assembled, reviewed, and prepared for filing. The visual summary on the right side provides a useful mental map. Schedule 125 handles active business income. Schedule 6 handles capital gains. Schedule 3 handles dividends. Schedule 7 serves as the investment income processing hub. Schedule 1 performs the tax reconciliation. And together, all of these schedules create the final T2 return. The key takeaway from this slide is simple. Every income item has a home. Every schedule has a purpose. And successful T2 preparation is really the process of identifying each income item and routing it through the correct schedule. Once you understand that flow, the entire corporate tax return becomes much easier to understand and prepare.